All right. Well, good afternoon, everyone. My name's Gabrielle. I work in marketing at Madrona Financial and CPAs. I just wanted to welcome you all for the Business Owners Playbook webinar series. We are so excited to have you all join us for today's session on preparing a business to maximize value. Before we get started, I just wanted to ask you all to please hold your questions to the very end. You can submit them below in the Q&A tab, and then the speakers will be able to go over them at the very end. So let's get started. Brad, do you want to do the next slide?
Yeah.
Speak.
So here's the mugs of the two speakers today. We wanted to do this because it's a very important topic. We'll be talking about. We're doing it in four sections because there's a lot to this. We're doing a deep dive. John and I just recorded a session on my radio show, but an hour wasn't enough, so we knew that going in. But we wanted to put this together. A little background on what we're going to be talking about today is, again, we're breaking it into four different webinars. So when is the right time to sell? A lot of people are concerned about the timing, and we'll get into that. The M&A market update, obviously the framework for maximizing value. We want to know how much we can sell for. How do we get to that figure? What's this EBITDA thing? Mistakes to avoid. It'd be nice in any business venture to not make mistakes that others have made. So that's called experience there, and we've got some of that. And then next steps. So with that, I'll just spend a second here. Who am I? If you don't already know, CPA for 40 years now, and own a investment advisory practice and do a radio show on Cairo, KTTH, KVI, a number of stations like that. Pretty much full service in our area where we integrate the CPA world with the investment advisory world, and which are two pretty important components or can be in any business succession. But let's get to the good stuff here. John, can you tell me a little bit about Chinook Capital Advisors?
Yeah. So first of all, thanks for the opportunity. This is, it's really my greatest honor and Chinook's greatest honor to work with business owners. And for most of our clients, this is it. This is maybe the most important transaction, most meaningful, most significant transaction of their lives. It cements their legacy in many aspects because if they do it right, they can set themselves up for personal financial success, as well as they can set the company up, for success under the next shareholders. And if they do it wrong, the other side of that is not pretty, right? Not every M&A transaction works out well, and not every valuation expectation is met. So hopefully today we can just give some wisdom based on our experience, our observations, how we work with business owners, and hopefully give some pearls of wisdom here and there that can avoid mistakes and maximize value. So just a word on Chinook. So I'm a co-founder together with Ed Kirk. 7 years ago, co-founded Chinook Capital Advisors. We're based in Kirkland, Washington. Clients are predominantly in the Northwest, Washington, Oregon, Idaho. We have a client in Alaska right now, and we're a team of 7 people. We cover, common industries, manufacturing, distribution, business services, healthcare, consumer, technology, food and beverage, aerospace. So really just businesses that you see running up and down the freeway. You see trucks, those are usually, either our clients or our prospective clients. When you pick an M&A advisor, you want to make sure that someone has reach, right? They want to get access to the right buyers, and we really do a phenomenal job of finding the right buyer. It could be, across the country. There's about 5,000 private equity firms right now that buy privately held businesses. So having intimate knowledge of which PE firms to talk to. We're also part of an international organization, ICA. So we have member offices in 39 countries, access to international buyers. And we got a proven track record. And we really love the opportunity to work with business owners and help them through this complex process.
an analogy I'm getting out of this is if I'm thinking about selling something as easy to sell as real estate, well, I can either go down to Home Depot and buy a for sale by owner sign and stick it out in front of my property and hope that a neighbor drives by that wants it. Or I can get on the multiple listings. So just that one aspect of it, just hearing about access to buyers is super important. That's something we can't do on our own, obviously. The other thing that kind of jumps out at me is all the core industries that you're in. I mean, that's a pretty wide swath there of different businesses that you could represent, and that's kind of one of the reasons I'm excited to do this with you. One of the questions I would have, John, is if I'm a business owner and I'm considering my transitions, what kind of choices do I have? Obviously, you have a great slide here, and I'll speak to some of my personal experience of that, but I want to turn this over to you. I'm not sure I like the third option, death there, but that's one way to say it. But sometimes selling to your own kids is similar to that anyway. Maybe there's some bad stories there too, but go ahead and take it from here on that.
Yeah, sure. So really, there's three three buckets. We are not immortal beings. We're mortal beings. So we have a finite time on Earth, and every business owner that's owned by a privately held individual, it's going to change hands, right? It's inevitable. So the transition options can fall into three buckets. The first would be an external sale. So you're really looking to sell the business, either a stock or asset sale, and you're going to be selling to a third party. A full sale is also called a buyout. So it's typically selling 100%, right? So some private equity firms are more buyout funds are looking to exit 100%. Certainly public companies generally acquire 100%. Large strategic companies would buy 100%. Another option, again, primarily with private equity, is a partial sale. So generally a majority sale, so 51 to say 90% sale, and then reinvesting. So selling the business, taking some of the proceeds, and then reinvesting it with the private equity fund to continue to be a shareholder, partner with that private equity fund to grow the business and sell it again down the road. So we call that a second bite of the apple, or selling your business twice. So that would be the external sale. On the internal sale, typically it would be selling to your management team if they have the means to do that. I think, and I would say 10 to 20 years ago, much more common for management teams to buy businesses from founders. I think business values were lower, and it was achievable. Right now, privately held businesses are traded at a much higher multiple, and frankly speaking, it's usually beyond the financial means of the management team, as well as the financial risk, putting personal guarantees on bank loans, et cetera. It's tough. But for smaller companies, maybe companies valued, $2 to $5 or $6 million, getting an SBA loan and selling to your management team is an option. Another in the internal sale is an ESOP. Again, there's just several hundred ESOP transactions in Washington State. Some companies are well poised for an ESOP. Generally, they would be larger companies, maybe 50 to 200 million in revenue and a wide employee base. Many construction companies operate as ESOPs. Some grocery stores have been ESOPs as well. So it takes the right situation to be an ESOP, and we could even have another show just to talk about pros and cons of all these. The third bucket is really just gifting, right? So you could maybe your kids inherit it through a trust. They want to you hand it over to them, and then the probate would be to do nothing, procrastinate to the bitter end, and then you don't have to worry about it. It'll be someone else's problem.
An example that I had, one of my clients in the veterinary arena, there's a lot of consolidation going on. So my client was able to sell a good chunk of their business, stay on as an employee because they really wanted the continuation there, and then convert the second and third payments into shares of stock of the bigger company that was consolidating everybody. So there was another chance to grow their valuation through that. You're right. There's used to be not as many private venture capitalists out there buying businesses. Now that's a big area. So there's a lot of options. Advantage to the external sale, of course, for the seller is getting cashed out. And that may not happen in the other two you have listed here. Certainly not in the third one there. So if you're leaving it to next generation, but there's advantages and disadvantages to everything. Sometimes external sale defeats your legacy desire. Maybe you want your company to go on. You want to know the people that are running it, whether it's family or key management and so forth. Pros and cons to everything, but I think that understanding this is a starting point of selling your business, and your succession plan is who you're going to sell to. Big topic. I did record a webinar, a farmer succession plan, huge for them because they want to leave it to their kids like they have for generation after generation, and now their kids all work at Google and Nvidia or whatever, and they don't want to farm wheat or whatever it is. So they're really having to analyze that from what it's been for generations. Next question I would have, businesses must always ask you, when is the right time to sell? Okay, I kind of have an idea who I might sell to someday or what I want to have happen, but how do I know when is the right time to sell, John?
Yeah, very, again, we're just setting the groundwork here for creating an exit plan. And again, just an analogy, they're never perfect, but, three legs of a stool, you take a picture of this with your mind and you'll never forget it. So, three questions. One is the market ready? So, the M&A market has ups and downs. Sometimes valuations can be very frothy. Sometimes the market can be very slow. Right now, and on the next slide, I'll get into that in a bit more detail. But last year was a down year in the M&A markets, for example. So, also for your industry, how deep is the buyer universe? Are there 30 or 40 potential buyers, or maybe less than 5, right? So, and if it's less than 5, are they in acquisition mode, right? Are they looking to grow through acquisition? So first question is the market ready? And if you think, well, I'm ready and the business is ready, but the market's not ready, then you might not hit your valuation expectations. The second question is, well, is the business ready? And that's what this whole presentation today is about. Do you have a growing business? Do you have healthy margins? Is a management team in place to continue to grow the business? As a business owner, are you essential to the business, or is there a path for you to exit as well? So we'll spend a lot more time on that. And then the third is the owner ready? And I really think of that in terms of emotionally ready, meaning, okay, I've been, the boss, the owner, I make decisions, I'm important, I have purpose, it's fun, I've had a great time. Am I ready to walk away from that emotionally? And then, is the owner ready financially? So, okay, well, what are we talking dollars wise, right? Okay, if I sell my business for $15 million and after, debt, fees, taxes, let's say I have $10 million. Well, is that enough for me to live, the rest of my life? If I'm 60 years old, I may have to live another 30. I guess the models run to 99 years old. So, is that enough money? And you really need to have confidence that it is enough. And you know, maybe Brian, pass it over to you, but how do you help business owners that are wondering, okay, well, you know, right now I take really as much money as I want to out of the business. You know, I'm accustomed to a certain lifestyle. Am I going to have to change my lifestyle after I sell the business, or can I just keep on doing what I'm doing?
Yeah, it's absolutely something we look at because we do a lifetime financial plan for that person before any of this is done. We want to see, okay, if you sell your business for X, let's figure out how the tax situation can work best for you. But generally, if you're putting money in your bank account, you're paying some tax. And so we want to do a lifetime financial plan. And really, during your lifetime, you've been focused on growing your wealth. The name of my radio show, by the way, Growing Your Wealth. And so you've done that. You have a successful business, but now you're looking more in retirement years as to the cash flow and security that you might be able to obtain. And the cash flow is different. You're no longer working at some point, and you may stay on for a while, but at some point you're not going to be working and earning money from your business. So you've got to replace it with other sources. So that is where we would come into place. And we'll be covering that more fully in the fourth part of the series here. I wanted to move on to ask you about the M&A market, what it looks like today, what it looks like going forward, and for how long. So maybe you can comment on that, John.
Sure. Yeah. So, you know, let's just take a look at these four boxes. The upper left is public market, so S&P 500, and looks good. You know, anything sloping to the upper right is generally positive, and the stock market is really the currency of M&A. You know, large multi-billion-dollar private equity funds are looking to exit their investments to the public markets. So public markets are down. It provides the ultimate liquidity for private equity, and it also you know, fuels public companies to continue their M&A strategies. So we're in a strong public market environment. Interest rates, well, you know, everyone that's alive today has experienced the most rapid increase in interest rates that have ever occurred. So we're living in historic times here, and I would say the financial markets are really adjusting to you know, living at a 3% interest rate and now in maybe the 7 to 9% range. It changes a lot. You know, it changes a lot of investment decisions. And even on the M&A side, you know, private equity funds that are modeling the acquisitions, the cost of debt is significantly higher, puts downward pressure on valuation. So certainly the peak time to sell, you know, 21, 22 market was flush with liquidity, very low interest rates. You know, 23 was an adjustment year. The financing markets were a little shaky as well. This year is, you know, we're off to a slower start than people had anticipated. People were hoping for 2024 to be a big recovery year, and so far it's a modest recovery year. So we're still kind of, the jury's out on the growth in M&A transactions this year. Fueling M&A, this is upper right corner, is private equity, and you know, I'm agnostic. You know, when it comes to private equity, you know, I've talked to thousands of private equity funds, and they're certainly not all the same. Their business model is to buy privately held businesses, to grow them and to sell them, and statistically, it's a very successful business model. So private equity firms have returned, you know, say, you know, a range of 20 to 30% IRRs to their investors. So they're able to buy businesses, scale them, combine them, and sell them for a profit. And the markets are rewarding them with more capital. So you look at, you know, that's 1,000 billion, which is a trillion. So there's $1 trillion of cash that's sitting in private equity funds ready to acquire privately held businesses. So if you look at, you know, the M&A markets right now, acquiring privately held businesses, any business owner's got to say, okay, is my business attractive to private equity buyers? And there's a couple of ways that private equity could buy, whether it's as a new platform or as an add-on to existing platform. But nonetheless, private equity is very dominant in acquisition of privately held businesses. All that being said, it's life's never easy. And there's uncertainties out there. We have this high interest rate environment, the financing markets, banks are more cautious. Is inflation, is it under control or not? Maybe Brian, you can talk about the future of interest rates. We're probably not going to see a recession. I think we've proven that. Supply chain is an issue, and we're working with business now. We have to value them, and we look at kind of what happened during COVID. But lots of interesting changes in costs, in freight, inbound freight, outbound freight, all related to supply chain disruption. So still has an impact on valuations today. Labor shortages, especially for businesses that rely on labor, very hard to find. Younger employees, we have a kind of a silver tsunami occurring, with tens of thousands of Americans retiring every year, and really not seeing replacement labor coming in to fill those positions. And then a little frosting and a cherry on top of the dessert here is it's an election year, so that's makes things spicy. And then from a future tax perspective, depending on who's in the White House, that can change kind of the outlook on the tax situation. So maybe Brian, you live in this world as well. Interested in your thoughts on just briefly on inflation and taxes.
Yeah, I think we saw this with, you mentioned the M&A activity has slowed down of recent, and people thought it would recover. I think I know why that is. It's because people thought interest rates were going to drop dramatically. Everybody said, oh, the Fed's going to drop rates 4 or 5 times this year. And that just hasn't even happened. And it may not even happen at all, let alone 4 or 5 times. And so we saw this in real estate last year. Definitely real estate slowed down, especially investment, commercial type real estate transactions really dried up. And a lot of people that I know that were planning on selling said, I'm going to hold off until rates drop. And so they're holding off to 2024. And now they're going, rates haven't dropped. I guess I'm going to keep holding off, but at some point they're going to want to sell, because I think we've entered kind of the new normal. Do I think rates could go down? They could. Are they going to go down to 3% again? No, that's not going to happen in my opinion. So we may have a new normal. So that would kind of fuel a lot of sales, because as you mentioned with the silver tsunami, most businesses are owned by baby boomers. The average baby boomer is 68, 69 years old. Most people have retired by the age of 68, 69. So there's the issue. We have all these businesses that are going to be transacted because people don't live forever. As you mentioned, we are mortal. Another thought I had was on private equity companies and so forth. A study by Blackstone came out. I used to think that most big companies were publicly traded. I was wrong. Over 80% of large companies are privately owned. Private equity owns them. Individuals own it. It's not publicly traded markets. So that's kind of a big deal there. So those are a couple of my thoughts on that, and that's why it's important to have this, because most commercial real estate and businesses are owned by baby boomers, and they're going, I'm not as young as I used to be. So with that, we'll go to the next slide here.
Go ahead. Well, I was going to say that this slide here is really the money slide of this deck. So if you own a business, and this what really I guess motivates me to work with business owners, and it is really the passion of my life, is I want business owners to be successful. I want them to, if they've owned a business, I want to see them have a successful exit. And just doing nothing, a failure to plan is a plan to fail. And an astonishingly high number of business owners just think, well, when I'm ready to sell, I'll sell. Or when I'm ready to sell, people are knocking on my door all the time and I'll just sell my business. And the truth, is very different. If you can create a plan, have an exit plan, and execute on an exit plan, you're going to create millions and millions and millions of dollars of value in your business. And it really does not take a lot of effort, but it just takes a little bit of time and being thoughtful. So this slide here really lays out the methodology. Step one is really the assessment. So let's figure out, what do we got today, right? Where's the business? What's the owner thinking? What are the owner goals? I want to exit in 1 year, 2 years, 3 years, 4 years, 5 years. I'm looking to fully sell the business. I'm interested to recap. I have partners that I want to buy out, or I want my partners to buy me out. So just kind of walk through. I'm thinking of an ESOP, but I haven't decided. My management team might buy it. I'm not sure. I have relatives in the business. I mean, sometimes there's just a lot to unpack with, kind of where are things today and what are the options. And then, really have an understanding of your industry, right? So if you're in home improvement, if you're in aerospace, if you're in, building products distribution, right? Whatever industry you're in, there's a story to tell, right? There is private equity firms that are focused on your industry. They've acquired your competitors. They have an acquisition strategy. There's public companies that have an acquisition strategy. So we can really, we pay for the subscriptions to PitchBook and CapIQ. So, for any business owner, we're happy to sit down and say, okay, in your industry, let's analyze, who's buying who and why. What's really driving M&A transactions, and try to identify, okay, well, who are the most active buyers in your industry, right? And that's a question that can be answered. So really, what's the business worth today? What's the market? What's the environment today? And then what's on your mind in terms of your timing and transaction options? Step two is, okay, well, if you have a bit of time, 1, 2, 3 years, what can we do to make things better, right? What can we do to build the value of the business, and what can we do to make the business more prepared for a sale? And so back to the slide with the 3 stools, we have to look at that. What does the business need to do to prepare for the sale, and what does the individual, the personal owner, need to do? And maybe there's some tax planning or setting up trusts, et cetera. So that, the step 2 there, the pre-transaction preparation, that gives you the time to execute, on the things that need to be done. And then on step 3 is entering into the full sale process. So it takes, on average, say 7 to 9 months to sell a business, right? So you're going to prepare marketing materials. You're going to complete a quality of earnings report. We'll talk about that. You're going to go to market. You're going to talk to the market, talk to investors, talk to buyers, get initial offers. You're going to have face-to-face management meetings. Ultimately, you're going to sign one letter of intent, and then you're going to do due diligence. So that whole process is about a 9-month process. So again, just to recap, and we'll go into a couple of these in more detail in the coming slides, but that's the framework.
Okay, that's a lot there, but as I always say on my show, just because it's hard doesn't mean it's a bad thing. Most good things are difficult, they're hard, whether it's retirement planning, income tax, estate planning, business succession. I mean, it's important. It's what you've done. It's what you've put together for your life. So appreciate these slides. These next few slides that we're going to get into here are going to talk about kind of the valuation numbers. We won't get too deep a dive on them, but just kind of touch on them. So we'll start with one of my favorite, actually the co-host of my radio show got me a hat once, one of my favorite baseball caps. It says EBITDA. And I gave a little prize to anybody at the last financial advisor conference that actually caught on to what that actually was. But that's accountants. It's pretty, CPAs, it's pretty easy to entertain us. But I like my EBITDA hat. Let's talk a little bit about EBITDA. If you could, you can bring it up, but I'll also interject on that.
Yeah, and just a side note, I did see a license plate on a car that said EBITDA. with a D
Nice.
on it. So EBITDA. So this is the takeaway. You know, any investor, I mean, yes, you have an income statement, right? You know what your net sales are, you know what your gross margin is, you know what your net income margin is, but you also need to be aware of two more numbers. One is your book EBITDA, right? So that's just simply taking your net income and adding back interest, depreciation, amortization, um, and um, and then the adjusted EBITDA, which is if somebody else owned this business in a normal operating environment, what would their EBITDA be? And so there's a methodology and a process for calculating adjusted EBITDA. But I think the takeaway I'd like business owners to think about is, do you know your EBITDA and your adjusted EBITDA, and do you track it on a monthly basis? And it takes some time to get drilled down to that number. So I have an example on the next slide, and I'll jump into it. So again, webinar 101, do not show slides with lots of numbers and small print. So I'm breaking that rule, but here, this is a company, 11 million top line revenue, 2 million of net income. But there are these adjustments, right? So there's interest, taxes, depreciation, amortization. That's really the book EBITDA. And then there's all these things that happen in the business that are either one-off transactions, or they're related to the owner, or it's something that's off market. In this case, there's a below market rent. There could be, you implement an ERP system, you did a big move. Maybe you have relatives or a spouse on payroll that is an expense that really shouldn't be there. We're not the IRS, we don't care. And I would say every business owner that I've ever met, runs some, personal expenses through the business directly or indirectly. So, that's very normal. But, when we are talking to investors, we want to say, hey, if you owned the business, the normalized EBITDA would be this number, and that's the number we're going to use to base valuation on. So here, a 2 million net income, but a 3 million EBITDA, or think about it, 18% net income margins, but 27% EBITDA margins.
And just on the outset there, if you're selling a business, let's just say you're selling it at 5 times EBITDA. The difference between that $2 million and $3 million figure is not $1 million, is it, John? It's $5 million. That's a big.
That's right.
So I think this is really important. Want to segue from that is quality of earnings report. Can you tell us about that?
Yeah, sure. So, getting to, this adjusted EBITDA numbers, of course, Chinook is staffed with, really smart, accounting and finance people. So, we can do a thumbnail EBITDA calculation, but ultimately, whoever buys your business is going to dig into the monthly financials, probably going back 2 or 3 years. So in preparation for a sale, we always recommend our clients to do what's called a sell-side Q of E, sell-side quality of earnings report. So they're going to hire a CPA firm to calculate adjusted EBITDA on a say a monthly and annual basis, going back 2 or 3 years. So when we're talking to investors, there's just no question that our books are in order. The other thing that the Q of E can do is it can adjust from cash accounting to accrual accounting. Most investors are going to be looking at your numbers on an accrual basis. They'll also look at working capital, look at CapEx. So it's really going to upgrade your financials, and it'll remove a lot of uncertainty when we get to due diligence, because that the buyer is going to hire their own CPA firm to do financial due diligence. So if we can head them off at the pass, and if there's any issues that come up in the QV report when we've hired our own accountants, it's easier to deal with it. If the issues come up when the buyer's CPA firm finds the issues, it's harder to deal with it, and it usually destroys value and sometimes blows up deals, right? So this is, over the last, I've been doing this for 30 plus years, but I would say over the last 15 years, this quality of earnings report has really grown significantly, to the point where I would say 80 or 90% of all transactions have a sell side Q of E before going to market. And it can be a slog to work with the CPA firm to get this done, but Chinook, we step up and manage the data room and the data flow and get through the process. But it's very critical. So the other analysis that we do at the front end here is a proceeds analysis. So it answers the question, okay, well, if I sell my business, in this example, $15 million, what do I get to keep? And so there's a few concepts that business owners may not understand. One is that businesses are often normally valued on a debt-free, cash-free basis. So what does that mean? It means that the buyer is assuming that you're going to be repaying all the debt in the transaction, and also the buyer is assuming that there's a normal level of working capital in the business and that you can take out all of the cash that's on the balance sheet. So typically, maybe the day or 2 days before closing, we take the cash out of the business, and that's distributed to shareholders. And then when the flow of funds comes in, any debt that's on the balance sheet's repaid, and then the transaction fees. So that would be fees for the investment banker, the lawyers, the accountants. Those get paid. So there's a net proceeds that happens at close, and then of course Uncle Sam. So we have federal, and now we have Washington State capital gains tax, unfortunately, and that's on the ballot in November. So maybe there's an opportunity for that to go away. We'll see. But the money number is the net proceeds number, and maybe Brian, you could talk to why that's an important number.
Yeah, I mean, that's certainly the basis for the retirement plan. And as I've mentioned in our fourth webinar, we're going to be getting into some tax savings opportunities there. So I'm not going to jump ahead here. We do have to scoot through a few slides here. Probably just briefly, John, could you talk about some of the issues on this slide?
Yeah. So, again, we're looking at, okay, well, what are the transaction goals? What's our valuation today? When do we plan to sell? So what should we be doing? What's our action plan between now and when we go to market? So we want to, again, look at the industry, the value drivers. We're going to create key strategic initiatives. Maybe one of those initiatives is to do a Q of E. Maybe one of those initiatives is to create a personal financial plan, right? So we look at the advisors. What advisors do we have around the table? Are there any seats that are empty? So we'll go through that in a future slide. And then what's the frequency? Like, when do we want to meet again? So for some of our clients, we're meeting every 3 months. Sometimes we're meeting every 6 months. But it's, we're saying, hey, we need to do some things here. Things have to get done, and it creates an accountability loop. And then for each meeting, we're going to update the M&A markets and the valuation as well. So create an action plan, make progress on it, and keep an eye on the markets and the business value over time.
I'd say one of the biggest problems with businesses selling, or the things that can really lower your price, is uncertainties. Uncertainties lower price. As a buyer, the more things I have to worry about, the less I want to pay for that thing. So you've identified some weaknesses here in your SWOT analysis.
Yeah, so SWOT analysis is a simple tool, but I think it's a great one. We look at things from, okay, well, what can derail, what can tank a deal, and is there anything we can do now to reduce that risk? So we talked about getting a Q of E report. Let's talk about key employees. So most businesses, yes, the owners, amazing, but there are also other amazing people in the leadership team, and there's always a risk, for the business owner to, worry that, well, I can't let my leadership team know. If they know they're going to leave, and I'll even have a bigger problem on my hands. But a better way to approach it, and our recommended way is to really have an honest conversation with your leadership team and say, hey, my phone's ringing off the hook. I get emails every day. at some point I need to start answering, some of these calls and talking to potential buyers and investors in our business. I want you to know that whatever happens, I'm going to take care of you. And if we get to a transaction that makes sense, I would like to pay you a bonus, a thank you bonus, a loyalty bonus, a retention bonus. Just to understand that you're important and to create alignment. And the other side of this is, if you run off on your own and your leadership team finds out and they get nervous and they have bills to pay and mouths to feed, and their phone's ringing too, right? So they may say, hey, I don't know what's going to happen here. You might sell the business to somebody. I'm going to lose my job. I have another company, another opportunity that maybe is going to give me more stability. So, sorry, it's been great, but I got to take care of myself. And you don't want that conversation to happen. So, getting retention agreements in place is an important step here. The owner dependencies, a plan to really delegate, look at what the owner does, and see if either people in your leadership team can step up and take responsibility, or you're looking at some key hires. But if the owner's goal is to retire, then ultimately everything that owner does is going to have to be done by somebody else. So having an honest conversation around that. Then I'll just jump to the last one here is the data room. So really every document that has ever existed in your business, every contract that exists has to be centralized in a VDR, virtual data room. So the corporate documents, financial statements, material agreements, all the employee information, benefits, intellectual property, anything related to litigation, all the insurance. So it is the great paper chase. And
well, that's why you have a team, John. So
yeah, we've had data rooms with tens of thousands. I mean, 1,500, 2,500, 5,000 documents in a data room, and all organized and easy to find. So, you can't do that overnight. It takes time, and getting ahead of it is important.
Right. So as we kind of go through some of these slides, we want to talk about just briefly some of the mistakes that business owners make.
Yeah, sure. So
let me take this first one, John. I was looking at a CPA firm once, and I went to him and I said, well, can you show me your financials? He says, well, I don't really have a financial statement. I said, how about your tax return? Well, I haven't done it yet. He showed me some schedules. I'm like, you want me to buy your CPA firm and you don't have, and then he gave me a cash basis kind of schedule. I was like, you have got to be kidding me. I couldn't run out of that place fast enough, not having accrual basis GAAP comparative financial statements. So we'll go on from there. As you mentioned, retention agreements. If you don't have anybody doing the work, in my own CPA firm, again, used to be Bob and I were doing all the billable hours. If we weren't there, there was no company. But now, all these years later, I haven't had a billable hour at my CPA firm in 18 years. I have created a business there. It's not reliant upon me. So that's, but my key employees would be taking care of that. And that's the dependencies you're talking about. Maybe you could mention a little bit on going to market.
Yeah, sure. Conversations with business owners, trying to time the market or test the market. I think those are recipes for disaster. Testing the market. Well, I'm not sure if I want to sell or not, but why don't we just, go to market and see what happens? You really have to have conviction, and that, hey, if this is the number, if we get to this number, I'm ready to move on. And going to market, it takes a toll on your company, on your leadership team. It takes a lot of time. You lose momentum in other areas. We manage confidentiality the best we can, but Sometimes, competitors find out, employees find out, and
People
if
know,
you're not.
and people know. I was in the office once, and everybody knew when these folks were walking through what was going on, even though no words were said. People had a spidey sense about that. So yeah, people do find out.
Yeah, so that's well, hey, I just had a great month. I want to sell my business, or hey, I have a key contract that's going to expire down in at the end of the year, so I want to sell my business before that contract expires. So you can't really any investor is going to look at all the issues. They're going to look at long-term trends and all those expiration dates. So you can't test the market. You can't go back one slide, Brian,
Oh,
and can't time the market. Yeah, I think the other mistakes I see is accepting the first offer. So lots of unsolicited offers, and it's really not based on meaningful due diligence. Business owners get an LOI, in the email or a written LOI and get excited, but you really just can't take those seriously. You really want to run a full process and talk to the market to find the right buyer. And representing yourself again, I've seen it. Many of our clients started representing themselves and quickly realized that was not going to work. It's a full-time job to sell the business and run your business. And also, it's hard to ask for the price yourself, right? You want someone to negotiate on your behalf
yeah,
rather than represent yourself.
right. Because there are a lot of questions that come up with, we don't have time to go through these, but these are some of the questions that certainly will be brought up. There's a lot to this. I think that's one of the underlying themes. But again, just because there's a lot to it doesn't mean it's a bad thing. Here's a repeat of a slide we had earlier just to kind of reiterate the step one, step two, step three parts of the business sale and pre-transaction. And pre-transaction, I think, is super critical, as you've been pointing out in this, for a successful result from all of this. Some of the resources that are available, maybe you could speak to that. And there's a QR code, it looks like here, for your firm there at Chinook Capital Advisors. Maybe you
Yeah,
could.
yeah. Actually, well, first of all, if anybody wants to follow up or a copy of the deck, please email me. But you visit our website, or you can use the QR code now. There's articles, resources for business owners to talk about, what is a Q of E, what does rolling equity mean, what do I expect to see in an LOI, how to prepare for due diligence. So all of what is adjusted EBITDA. So all these fun topics that are new to most business owners, but things that we deal with every day.
Yeah, and I think that just again, one of the takeaways you might make from this is start planning early. It doesn't hurt to plan early. I talk about this on my show all the time about retirement planning. My co-hosts always ask me, Brian, when's the best time to plan? And I say yesterday, and the second best is today. And so today's a good day to start thinking about that. Even if though you're not going to do something right away, but understanding it, the more that you learn about this, that's probably why you're on this webinar and watching it right now. And so there's a lot to this. I wish we had time to go through all the rest of those questions, but certainly we're here to help with that. But hopefully you got a picture of that QR code. Here's another one for you. I've recorded 98 videos on my website. They're in many different areas, whether it's taxation, real estate, business succession. It could be annuities or investments or the state of the market, whatever the case may be. I kind of sat down. I thought, gosh, here's about 100 things I talk about with my clients, but I repeat these same topics in different order over and over and over. So I just decided to record them all. They're only about 5, 6, 7 minutes each. So if you want to look into particular topics, that's a easy way to do that. And you don't have to read the whole book. You just have to listen to me speak for about 6 minutes. And wanted to give some contact information here. If you wanted to email one of us here, you certainly can do that. We'd be happy to help you with that, whether you're starting the business succession part and you want to speak to John, or if you have financial planning, income tax, estate planning, real estate type succession planning questions, you can email me, of course. and we're here to help you. So we look forward to more of these. We've got dates coming up, June 13th, June 18th, June 20th, to continue a deeper dive into the discussion on the Business Owners Playbook series. And so if you want some more information on that, got lots of QR codes for you to follow up with here. So, but just reach out to us if there's something that you weren't able to pick up while you were watching this. So I'm going to end it right there, John. I really appreciate you being on today. Look forward to seeing you in 2 days. And we'll do this again with a deeper dive into the steps in the sales process. And thank you for being on the show today. I guess it's a show, it's a webinar or a webcast or a podcast. I don't know what they call them anymore, but enjoy doing that with you today.
Did we have any time for questions, or did we run out of time?
Oh, I think we do. You have any questions?
Yeah, if anyone wants to enter their questions in the Q&A section, we can review those and have our speakers answer them for you. Or raise their hand and we can open up your speaker. Okay.
Any help on the buying side is the one.
Yeah, sure. Yeah, buy side. I would say there's two types of buy side advice in the market. So one is, if the buyer and seller already know each other, and you just really need help to get a deal done, we're happy to help with that. If you own a business that you're planning to sell in the future, and but you think you want to do some acquisitions to grow the value or consolidate or take out a competitor, but it's leading up to the future sale, we can do that. The type of buy side work that we don't do is someone that just says, hey, I want to buy a business, but I don't know what I'm looking for, or a corporation that says, yeah, I want a growth or acquisition and I want to see everything. So we're not going to go source, the buying opportunity, but if there was a finite list of target companies that needed to be approached and it was well defined, then we'd love to have a conversation about that.
Thank you for that. I think that was it for the questions. So with that, we'll sign off and everybody get back to their day. Thank you.
All right. Thanks, everybody.